China just did something that should have made front page news in every financial outlet on the planet. It didn't. Buried in a government bulletin 3 weeks ago was a single paragraph. New export licensing requirements for refined silver. Effective immediately. No grace period, no exceptions. What that paragraph actually means is this. The country that refines 40% of the world's silver just turned off the tap to the West. And they did it so quietly that most traders still don't know what happened. The price on your screen says $90. The price in Shanghai says $103. That $13 gap is not a glitch, it's a wall. And you're on the wrong side of it. I'm a private commodities analyst. I've been tracking physical metal flows for over 12 years. I built this channel because I was tired of waiting for mainstream financial media to report what I could already see on my terminal. And right now, what I'm seeing is a fracture, a break in the global silver market that's going to reshape everything we thought we knew about supply, demand, and price discovery. So let me walk you through what China actually did, why it matters, and why the price you're looking at right now is becoming meaningless. Let's start with the basics, because most people don't understand where their silver actually comes from. When we talk about silver production, we usually talk about mining, Mexico, Peru, Australia. These are the countries that pull silver ore out of the ground, and yes, they're important. But mining is only half the story. Raw silver ore is not what ends up in your electronics. It's not what backs futures contracts. It's not what sits in COMEX vaults. Before silver becomes useful, it has to be refined, smelted, purified, transformed from rock into bars and rounds and industrial feedstock. And that's where China dominates. Chinese refineries process approximately 40% of the world's silver. 40%. They import raw material from mines all over the world, and they export finished product back out. They're the factory floor of the precious metals industry, the bottleneck through which almost half of global supply has to pass. For decades, the system worked, or went in. Refined metal came out, everyone got what they needed. 3 weeks ago, that system stopped working. Beijing published new regulations requiring export licenses for refined silver and silver products. On the surface, it sounds like paperwork, bureaucracy, red tape. But here's what's actually happening. Those licenses aren't being approved. Applications are sitting in government offices. Shipments are being delayed. Containers that should have left Shanghai 3 weeks ago are still sitting in warehouses waiting for a stamp that never comes. The official explanation is national resource management, strategic reserves, economic security. The real explanation is simpler. China wants to keep its silver. Let me show you what this looks like in the market, because the numbers don't lie. Right now, if you pull up a quote for silver in New York, you'll see something around $90 an ounce. That's the COMEX price, the paper price, the number that every financial website shows you. Now pull up the Shanghai Futures Exchange. Convert the UN price to dollars. What do you get? $103. Same metal, same specification, $13 apart. In a normal market, that gap would close within hours. Traders would buy silver in New York at 90, ship it to Shanghai, sell it at 103, and pocket the $13 spread. That's called arbitrage. It's the mechanism that's supposed to keep global markets in alignment. But the gap isn't closing. It's been sitting there for weeks, widening. And the reason is simple. You can't arbitrage if you can't get the metal out. Chinese refineries have silver, plenty of it, but they can't export it without a license. And licenses aren't being granted, so the metal stays in China. And Chinese buyers, who need silver for their solar panels and their electronics and their industrial manufacturing, they're bidding up the local price because they have no alternative source. Meanwhile, the West is looking at a screen that says $90 and wondering why they can't actually get metal at that price. This is where it starts to get dangerous. The $13 premium in Shanghai isn't just a number, it's a signal. It's the market screaming that physical silver is scarce, that the paper price has decoupled from reality, that the comfortable assumption of global supply chains working smoothly is no longer valid. And it's not just China. When China restricts exports, the ripple effects spread everywhere. Think about what Chinese refineries actually produce. Silver paste for solar panels. The photovoltaic industry runs on Chinese silver paste. If that supply gets cut, solar panel production slows down, not just in China, everywhere. Because Western manufacturers depend on Chinese suppliers. Silver powder for electronics, your phone, your laptop, your car's control systems. All of them contain silver components that came from Chinese refineries. Restrict that supply, and you've got a problem that reaches into every sector of the economy. Industrial silver for medical devices, for water purification, for batteries, for catalytic converters, all of it flowing through that 40% choke point that Beijing just decided to narrow. The West didn't just lose access to Chinese silver, it lost access to Chinese refining capacity. And you can't rebuild that capacity overnight. You can't snap your fingers and create new smelters in Nevada or Germany or Australia. That takes years, billions of dollars, permits and construction and skilled labor, In the short term, there is no alternative. Now let me address the skeptic, because there's always someone who says this isn't a big deal. The skeptic argument goes like this: China is just managing its resources. They've done this before with rare earths, with various industrial materials. It's temporary. It's political. Eventually, the licenses will get approved and trade will resume. This is noise, not signal. Here's my response. First, look at the timing. China didn't implement these restrictions randomly. They did it while COMEX vaults are at historically low levels, while Western industrial users are scrambling for supply, while the paper-physical gap is already wider than it's been in years. This isn't random. This is strategic. Second, look at China's own behavior. While they're restricting exports to the West, they're accelerating imports of raw material. Chinese refineries are still buying ore from Mexico and Peru and Australia. They're still running at full capacity. They're just keeping the output for themselves. That's not temporary resource management. That's stockpiling. That's preparation for a world where silver becomes scarce and whoever holds physical metal has power. Third, look at the industrial landscape inside China. They're building more solar capacity than the rest of the world combined. They're expanding EV production. They're investing in electronics manufacturing. All of these industries consume massive amounts of silver. China isn't restricting exports because they have too much silver. They're restricting exports because they don't have enough for their own needs. And they've decided that their needs come first. The skeptic says this will blow over. The data says this is just beginning. Let me show you what this means for the COMEX, for the Western paper market that most investors still think is real. The COMEX futures market depends on the assumption that paper contracts can be converted to physical metal. That's what gives the paper price any meaning at all. You can buy a contract, hold it until expiration, and demand delivery of actual silver bars. But what happens when there's no silver to deliver? We've already seen COMEX registered inventories falling for 18 months. The metal that's actually available for delivery has been bleeding out. Large players taking physical, not rolling contracts forward, actually demanding the bars. Chinese refineries were one of the backstops. When Western mines couldn't keep up, when supply got tight, Chinese refined silver could flow into the system and fill the gap. That backstop is gone now. So where does the replacement metal come from? Mexico is producing, but there are other constraints on that border. Australian mines are running, but shipping times are long. Recycling can contribute, but scrap supply is finite. The math doesn't work. Demand exceeds supply by hundreds of millions of ounces per year. The deficit was being covered by drawing down inventories and importing refined metal from abroad. Now one of the largest sources of that refined metal has been cut off. The COMEX can keep printing paper contracts. They can pretend the price is $90. But when the delivery window comes and there's no metal in the vault, the pretending stops. Let me tell you about the industrial panic that's already starting, because this isn't just about stackers and speculators. This is about companies that need silver to operate. I've been hearing from contacts in the solar industry, manufacturers who are suddenly facing supply shortages they never anticipated. They had contracts with Chinese suppliers, reliable relationships going back years, and now those suppliers are saying, sorry, we can't ship. Government orders. What do you do if you are a solar panel manufacturer and 40% of your silver paste supply just disappeared? You panic. You start calling every alternative supplier you can find. You offer to pay premium prices. You start stockpiling whatever inventory you can get your hands on. And when 100 companies are all doing the same thing at the same time, what happens to prices? They go vertical. This is the dynamic that the paper market doesn't capture. The paper market sees supply and demand as abstract numbers. The physical market sees real companies desperately trying to secure real metal for real production lines. Those companies don't care if the screen says $90. They'll pay $110, $120, $150, whatever it takes to keep their factories running. And that desperation is just starting to show up. Here's what I'm watching right now. The indicators that will tell me how bad this gets. First, the Shanghai Premium. That $13 gap between Eastern and Western prices. If it stays at 13, we're in a new normal. If it widens to 15 or 20, the fracture is accelerating. If it narrows, maybe the skeptics are right and this blows over. But it's not narrowing. As of this morning, it's wider than it was last week. Second, Chinese customs data. Monthly reports on silver imports and exports. If we see exports collapse while imports stay high, that confirms the stockpiling thesis. China taking in raw material and keeping the refined product. Third, COMEX delivery reports. The daily data on how much metal is being claimed against futures contracts. If delivery demands spike while inventories fall, the squeeze is real. Fourth, dealer premiums in the West, APMEX, JM Bullion, SD Bullion. What are they actually charging for physical metal? If premiums expand from 20% to 30% to 40%, the physical market is telling you the paper price is fiction. Fifth, industrial earnings calls. Listen to what solar companies and electronics manufacturers say about their supply chains. If they start warning about silver shortages, about production delays, about margin compression from raw material costs, that's confirmation. These are the tells. These are the signals that will show up before the mainstream headlines catch on. Let me put this in perspective. Let me show you why this matters beyond just the silver market. What China did with silver, they can do with any critical material: rare earths, lithium processing, battery components, pharmaceutical precursors. Any supply chain that runs through Chinese manufacturing is now subject to this same risk. Beijing has demonstrated that they're willing to weaponize their industrial capacity, that they'll prioritize domestic supply over international trade relationships, that decades of globalization assumptions can be overturned with a single government bulletin. This isn't just about silver. This is about the architecture of the global economy, an architecture that assumed materials would always flow freely across borders. That assumption is dead. And silver is the canary in the coal mine, the first crack in a system that is going to show a lot more cracks in the months ahead. So where does this leave you? The paper price says $90. Shanghai says 103. Your local dealer says 90 plus a 30% premium if they have any inventory at all. Which price is real? The one you actually have to pay to get metal in your hand. That's the real price. Everything else is a story, a fiction, a number on a screen that's becoming less meaningful by the day. China built a wall, not out of concrete, out of paperwork. Export licenses that never get approved, bureaucratic delays that stretch into infinity. And on one side of that wall, silver is available. On the other side, where you're standing, it's becoming scarce. The gap is $13 today. Where will it be in a month? In 6 months? When the next comics delivery window comes and the vaults are empty? I don't know the answer. Nobody does. But I know which direction the trend is pointing. The screen is still lying to you. It's showing you a price that exists only in the paper market, a theoretical number disconnected from physical reality. And somewhere in Beijing, someone is watching that gap widen and smiling. Because they saw this coming. They positioned accordingly. They secured their supply, while the West was still debating whether inflation was transitory. The wall is up. The tap is closed. And the price you're looking at right now is a memory of a market that no longer exists. Watch the premium, watch the vaults, watch the chaos. I'll see you in the next one.